Welcome to today's financial education session. Our focus is on one of the biggest financial commitments most people will ever make, a mortgage. A mortgage is a type of loan used to buy real estate, usually a home. Understanding its key terms will help you make informed decisions, avoid costly mistakes, and plan better for your financial future. We'll break this down into 6 essential concepts: principal, interest, down payment, term, equity, and mortgage calculators. By the end, you'll not only understand these terms, but also know how to apply them when evaluating your own housing options. Meet Lisa. She's 29, works full-time, and has been renting for years. Now she's finally ready to buy her first home. She's excited. But when the banker starts using terms like principal, amortization, and equity, she feels completely lost. This is where many buyers stumble. So let's break down each term through Lisa's journey, so you'll never feel unprepared. Section 1, Principal. Definition. The principal is the amount of money you borrow from the lender. Example: home price equals $300,000. Down payment equals $60,000. Principal equals $240,000. Why it matters. The principal determines the size of your loan, your monthly payments, and the total interest you'll pay over time. Financial education point. A higher down payment reduces the principal, which saves you money long term. Lisa finds a home priced at $300,000. She saved up $60,000 for a down payment. That means she'll need to borrow $240,000 from the bank. Lisa realizes that her down payment directly lowers her principal. If she had only $30,000 saved, her loan or principal would have been $270,000, which means more debt and higher payments. Section 2, Interest. Definition. Interest is the cost of borrowing money from the lender. Types. Fixed rate, same throughout the loan, versus variable/adjustable rate. Changes with the market. Example: $240,000 loan at 5% equals $12,000 in interest for the first year. Why it matters. Even a 1% difference in interest rate can mean tens of thousands of dollars over the life of the loan. Tip: always shop around and compare interest rates from different lenders. The bank doesn't lend money for free. On Lisa's $240,000 loan, the first bank charges a 5% interest rate. That means in her first year, she'll pay about $12,000 in interest alone. Lisa shops around and finds another bank offering her 4.5% instead of 5%. Over the life of her loan, that 0.5% saves her over $25,000. She's glad she asked questions. Section 3, Down Payment. Definition. The upfront cash you pay toward the purchase price. Common amounts: 5%, 10%, or 20% of the home price. Example: $300,000 home, 20% down equals $60,000. Why it matters. A larger down payment reduces your principal. It lowers your monthly payments. At 20% or more, you can often avoid private mortgage insurance, PMI. Financial education point. Saving for a larger down payment is one of the best ways to make homeownership more affordable. Lisa knows the more she pays up front, the less she owes later. With her $60,000 down payment, she's already cut her loan size by 20%. That also means she avoids something called PMI, private mortgage insurance, which many lenders require if you put less than 20% down. Lisa briefly considered putting down only 10%, so she'd have more cash left over. But after running the numbers, she sees a 20% down payment saves her hundreds of dollars each month. She chooses a larger down payment and feels more secure. Section 4, Loan Term. Definition. The number of years you have to repay the loan. Common terms are 15, 20, or 30 years. Example: 15-year loan, higher monthly payments but lower total interest. 30-year loan, lower monthly payments, but more interest over time. Financial education point. The term affects both your monthly budget and your total long-term cost. Choose based on income stability and financial goals. The bank gives Lisa two main choices: a 15-year loan or a 30-year loan. With 15 years, her monthly payment is higher, but she pays far less in interest overall. With 30 years, her payment is more affordable each month, but she'll pay a lot more interest in the long run. Lisa picks the 30-year option because she wants breathing room in her budget, but she makes a mental note. When her income grows, she'll pay extra toward her loan to build equity faster. Section 5. Equity. Definition. Equity is the portion of property you actually own, home value, remaining loan balance. Example. If the home is worth $300,000 and you still owe $200,000, your equity is $100,000. Why it matters. Equity grows as you pay down the loan, and as the home's value increases. You can tap into equity later through refinancing or home equity loans. Financial education point. Equity is a wealth-building tool. Think of it as an investment in your financial future. Equity is how much of the home Lisa truly owns. Right now, her equity is $60,000, her down payment. Over time, as she pays down the mortgage and as her home value rises, her equity will grow. Lisa imagines herself in 10 years. Her mortgage balance will be much lower, her home value will hopefully be higher, and she'll build up a solid chunk of equity, real wealth that she can use. Section 6. Using mortgage calculators. What they do: show you estimated monthly payments based on home price, down payment, interest rate, and term. Why they're useful: help visualize affordability before talking to a lender, allow you to compare different down payment and loan scenarios. Exercise for viewers. Try adjusting the down payment from 5% to 20% and see how much the monthly payment changes. To help her compare options, Lisa tries an online mortgage calculator. She enters the $300,000 home price, her $60,000 down payment, a 5% interest rate, and a 30-year term. Lisa feels more confident. The numbers aren't a mystery anymore. She sees exactly how her choices affect her monthly budget. Recap: principal equals the loan amount. Interest equals the cost of borrowing. Down payment equals your upfront contribution. Loan term equals how long you'll be repaying. Equity equals your ownership stake. Mortgage calculators equals planning tools. Understanding these terms equips you with the financial knowledge to evaluate mortgage offers, negotiate with confidence, and plan for homeownership responsibly. Through Lisa's story, we've learned principal is the loan amount. Interest is the cost of borrowing. Down payment reduces your loan and saves money. Loan term affects your monthly payment and long-term cost. Equity is your ownership stake in the home. And mortgage calculators make planning simple. Conclusion: mortgages don't have to be intimidating once you know the language. If you apply these concepts, you'll be in a much stronger position when it comes time to buy a home. Thank you for joining this financial education session. For more lessons on money management and smart financial decisions, don't forget to subscribe and keep learning. Thanks for watching. Don't forget to like, share, and subscribe.